So hey there, welcome back to another video. And in this video, we'll be talking about a playbook to properly implement pay-as-you-go pricing. So playbook to properly implement pay-as-you-go pricing in your SaaS product or any other product. Usage-based pricing, consumption-based pricing, and PVG. PayG, pay as you go, PAYG, pay as you go are relatively new SaaS pricing models that enable you to drive both top of the line growth while also increasing net revenue retention over more traditional subscriptions. Pricing models such as license or seat based pricing with pay as you go. A customer only needs to pay for what they consume, such as hours of a VM or a number of messages sent. Send APIs naturally are transaction based, which make them suitable for new consumption based pricing. In fact, all three cloud providers, AWS, Google, and Azure, leverage consumption based billing so their customers can optimize their infrastructure. Prepaid versus postpaid billing. First, you will want to decide whether you want prepaid or postpaid billing. Prepaid billing requires the customers to purchase credits to or pre-negotiated debt quota ahead of time, creating a positive balance that is then burned down. If they are credits, a customer will need to periodically top off their account by purchasing additional credits before they run out. Some systems enable automatic top off once a balance falls below a defined threshold. This can improve your business cash flow since you are able to leverage the spent capital even before any costs are incurred to deliver their services. Irrespective of pay as you go, most enterprise companies require enterprise contracts to be prepaid for the term, as prepaid enables more payment options such as bank wire or ACH. Customers also benefit since they can set hard budgets for your service and disable any auto top offer functionality. The downside of prepaid billing is the additional friction added when purchasing a plan when usage is not predictable, especially if it is not bundled amount. Prepaid billing requires the customer to estimate how much to purchase even before even using the service, which can also cause more refund requests if they don't end up using the credits unless a card is on file. Collecting additional fees due to overage or term violations may be harder. Customers may be opposed to prepaid billing since the capital is end up uh, So continuing the video, the next one is the billing frequency. You will also need to decide how often a customer is billed, which is related to whether you leverage prepay versus postpay. Billing one option is to invoice periodically, such as the ninth day of the month. This makes it easier on your customers. Billing department as your service more predictable while minimizing extra work to pay invoices. This is also easier to understand as most SaaS subscriptions are already billed annually or monthly. It is not recommended to have a common billing day for all customers like the start or end of the month, as this can cause your support team to deal with a flood of billing requests on that day. So a second option is a threshold based. It's if prepaid billing, a customer needs to purchase credits, which is in turn needs to be topped off once the balance drops below a threshold. Many systems allow this to charge a card automatically, such as when the balance drops below $10 and $100 worth of credits. If you implement postpaid billing, the threshold is simply the reverse. Is that in that when the negative balance goes above the threshold, such as $500, an invoice is generated and the credit card changed. This is increasingly common in self-serve advertising. The downside is a lack of predictability, since some months could have many more charges than other months. If not careful, this can generate an unnecessary number of invoices with small charges. Similarly, this can cause a nightmare for your accounting team and harder to predict future revenue. The next one is billing measurement. Based on your billing time and frequency, you will need to implement a system that can accurately measure and report on transaction volume for each customer account. This account means having an analytics system such as an API on API calls or transactions. Because each customer may have a different billing period, your analytics solution should have a way to handle this. If you leverage periodic billing, then you can query a customer's usage when you invoice them, which is usually on a predefined billing day. So for threshold billing, measurement may be a little more tricky since an invoice can be generated at any time, not just on the customer's billing day. This means you need to keep track and trigger invoices once the threshold is reached.